Good afternoon, everybody, and welcome to our webinar on Employee Ownership Trust. You're joined today by myself, Natasha Millward, and one of the Client Service Directors based in our Manchester office, and Connor Smith, who's one of the Senior Tax Managers for the group. So a couple of things just to mention in relation to the webinar today. We are being recorded, and the recording will be sent out following the session, along with the slides and a couple of articles, along with a link so that you can, if you find the webinar useful and want to learn a bit more and speak to one of the team, you can arrange a meeting directly with one of the team. If you've got any questions that you want to ask, then there is a Q&A box next to the share button that you can drop any questions into, and we'll cover those at the end. So just on myself, so I'm Natasha Millward. As I said, I'm one of the Client Service Directors based out of our Manchester office. I'm a qualified accountant, and I rejoined the business last year after spending a number of years in an industry role and internal at a legal and professional services business. My role at DJH, so I work closely with our clients who are predominantly owner-managed businesses on their succession planning. So that's planning for the future and making sure that the right team is in place to continue with the business moving forward. I also work on restructuring, so ensuring that the right structure is in place, whether that be because there's an exit strategy or whether that's because we want to safeguard assets. And also help clients from a valuation perspective, so we can understand the true value of the business and put some plans in place for the future. Also from a compliance perspective, so day-to-day questions, queries, working with clients to sort of get to a position for the year-end accounts and year-end compliance reporting. And then also in relation to acquisitions and disposals. So we've got some clients that are growing significantly through acquisition and we'll support through that process, or that they've got an exit strategy in place and supporting through the sales. So for those of you that don't know much about DJH, so we are a top 40 accountancy practice and business advisory firm. We've got offices across the UK within sort of the Midlands, North West, Yorkshire and South East, and we provide various services to our clients. So that includes your standard accounts, tax, audit and payroll, but we've got a few specialist services as well, such as corporate finance, research and development, capital allowances and commercial funding. And the key for us is to become that trusted advisor for our clients and be able to advise on various different situations through sort of start up all the way through to an exit plan. So without further ado, I'll pass over to Connor and we'll pick up specifically on the EOTs. Thanks, Connor.
Cheers, Tash. So hello, everyone. I'm Connor Smith, one of the Senior Tax Managers at DJH. I joined in September 2022 and had done a number of EOTs before I've joined. CTA qualified, so I've been doing tax for about 15 years now. And specialise in EOTs. So we do quite a number of EOTs now. Probably did about 10 or 15 of them last year. We've got quite a number on already this year, and so yeah, we'll take you through some of the points around EOTs. So again, just very quickly, just to give you some background, I work quite closely with Tash on the succession planning. So we do a lot with sort of tax strategy, whether that's corporate tax, personal tax, inheritance tax, however that looks really, when someone's looking at an exit or some sort of succession plan. Do a lot with restructuring, again, exactly the same as what Tash does. We do a lot with share schemes, which is mainly incentivizing key staff and how do we keep them motivated and retained. And then, the IHT is mentioned, and as well as demergers. So demergers is generally common when we're looking at sort of separating businesses out, for example, if you don't want to sell your property on sale. So if we just jump straight into EOTs then. So EOTs have been around a bit longer than what everyone thinks. Everyone thinks they've been around 3 or 4 years. Came in about 2014. And to be honest with you, no one did them for the first 5 years. And I think the main reason for that is that for those of you that have come across what used to be called entrepreneurs relief before, what's now called business asset disposal relief, that used to be an allowance of £10 million per person, and the result is that you only pay 10% capital gains tax. And so, if husband and wife owned a company, they could sell a business for up to £20 million and only pay 10% tax. I think the difference between doing that and an EOT, where you get 0% CGT, it probably wasn't big enough for someone to become a guinea pig effectively and sort of try and become an EOT. What then happened in about 2019 was that £10 million limit came crashing down to about 1 million. So if someone was selling the business again for, £20 million, their effective rate of tax basically doubled overnight. And that's when people started looking at EOTs. Ever since then, they've become a lot more of a well-trodden path. We've done quite a lot of them now. We know what we're doing with them, and they are becoming increasingly popular, not just because of the tax benefits, but all the commercial benefits that you can derive from it as well. And they're a new and sort of a new alternative to a more sort of traditional sort of management buyout. So you still need to have a good management team in place. You don't necessarily need to have a management team in place that can take over from you on day one. There can be a sort of steady sort of handover, but you still need to have a strong management team in place. And to try and incentivize people to become EOTs, there are a variety of tax benefits to both the seller and to the employees of the business. Which begs the question, what are the benefits? So if you were to sell your business to an EOT, it's a tax-free sale of shares. So there's no CGT whatsoever. So it doesn't make a difference if you're selling the business for £1 million or £1 billion. There's still no capital gains tax whatsoever. For those of you that have come across entrepreneurs relief before, there are some sort of more technical requirements in order to qualify for entrepreneurs relief. Like you need to hold it for a certain number of years. You need to own it at least X percentage. None of that applies to EOTs on disposal. So the sale is just CGT free, and it's better than what used to be entrepreneurs relief or business asset disposal relief, especially if you're selling for more than £1 million. Current CGT rates are 14% and 24%, and that's going up to 18% and 24% from next April. And so, comparing that with no CGT is a big win. For the employees, once you become an EOT, you're able to pay tax-free bonuses of up to £3,600 per year to your staff. The bonuses are still charged to national insurance. I can't tell you why. I think that was, if I'm being honest with you, that was an oversight in legislation. But there's no income tax on the bonuses up to £3,600. It incentivizes the staff to sort of grow the business and generate the bonuses. So overnight, what you'll sort of start to see is that the employees' interests become more aligned with your interests. So the employees want the business to be more profitable, so that when there's more profits, there'll be more that we paid out to the staff as bonuses. And so it incentivizes the staff to sort of grow the business going forward. The employees don't actually own shares, and therefore there's no need for sort of complicated buy-ins and buyouts every time someone leaves and joins. So we've got a different slide a bit later on that talks about the structure of an EOT and sort of how that works. And we'll explain that a little bit more on there. But basically, if someone leaves, they automatically cease to be a beneficiary. If someone joins, they automatically start to become a beneficiary in general. You can go down a route where you could further incentivize senior management with share options. So if anyone's come across them before, there's something that's called an EMI scheme or enterprise management incentive. And so what we've done on some of our EOTs before is that we've sold 100% of the shares to an EOT. And then we've granted some share options over some of those shares to senior management to further incentivize them and sort of, keep them happy, keep them around and keep them making profits for the business. And the last one is one that I think sort of overlooked quite often, and especially at the moment when it feels like nobody can recruit anybody at the moment. Those tax benefits can make the future recruitment of good quality staff easier, certainly in the ones that we've done. the clients that have done the EOTs have seen staff retention improve significantly. And like you say, the recruitment becomes a lot easier because if you've got two identical job offers, but under one you can be you're a member of an EOT, you can have some tax-free bonuses, and you've got an indirect shareholding in the business. In my opinion, you're only going to pick one of those job offers probably.
Just before I jump ahead, Connor, I think one of the key questions that we get asked from clients is around the tax-free bonuses and whether you can only pay 3,600 a year, and if there are already bonuses in place for those employees, what happens if they are higher than that value?
Yeah, so it's a good question. So if you imagine it, there's sort of two different types of bonuses that you can have. So any contractual bonuses that are still in place, they can continue to be paid, but they don't get paid. They don't count towards 3,600 exemption. Normally, what we say is that those tax-free bonuses are in addition to any current package that they've got. If you can pay less than £3,600. In theory, you can pay nothing if you wanted to. You don't have to pay that limit, so you could pay 500 quid. If you had a particularly good year and you decided you wanted to do a bonus of £5,000 each to all the staff, then the first 3,600 is not charged to tax. It's only balance above that is charged to tax. When we're working out what these employee bonuses are, there is a set criteria to determine how those bonuses can be paid, and broadly it comes down to one of three things. The bonuses have got to be in conjunction with how many hours that person works. So a full-time staff would get X, part-time staff would get Y. You can do it based on remuneration. So if you're declaring a bonus pot, let's say of £100,000, then you'd say those that have got the highest remuneration get a bigger slice of the pie. Or you can do it based on length of service. So those people that have worked there the longest get a bigger proportion of the pie. But either way, it's not a you've got to pay £3,600 or nothing. You can pay anything below or above it. So if you want to sell to an EOT and you want to qualify for the capital gains tax exemption, what conditions do you need to meet? So the company's got to be a trading company, or you've got to have a holding company of a trading group. What that means is that you can't have, as a rule of thumb, you can't have more than 20% of your turnover, gross assets, director's time or income relating to investment activities. So if you've got investment property in there, that might cause an issue, but there is planning that we can do. It is worth noting that condition only needs to be met at the time that you sell to the EOT. So if you have got an investment property in the trading business at the moment, and you're worried and you're thinking, well, that might scupper me from being able to claim it. If we extract the property before we do the EOT, and then at that point the business is just a fully trading business, you're absolutely fine. So there are things that you can do, but we just need to be careful if you have got some investment activities. As a result of the sale, the EOT's got to own at least more than 50%, I should say. So you don't have to sell exactly 51%. You don't have to sell exactly 100%. You can sell anything anywhere in between. And normally that comes down to sort of, a couple of decisions in terms of how much cash do you want out, how much longer you're going to keep working for, when's your predicted retirement age, how much cash do you need for retirement. There's quite a lot of factors that go into that decision. Which we'd sort of work with you to sort of help determine what a sort of accurate number is in terms of what we'd look at selling. All of the employees have got to benefit equitably from the EOT. So again, that point is what I mentioned on the bonuses on the previous slide. So all employees, you can't pick and choose certain employees to be members of the EOT. It's got to be all of them. All of the employees can only benefit on the exact same terms, and that'll either be bonuses and any future sale proceeds are paid out in accordance with the amount of hours that they work. So again, full-time X, part-time Y, based on your remuneration. So if you get paid more, you'll be deemed to be more, you're deemed to be more important to the business, and therefore you get a bigger slice of the pie, or you can do it based on length of service. The last condition is very hard to write down, to be honest with you. So I'll read that one out, but then I'll probably just go through an example just to sort of hopefully make it make sense. So in the 12 months prior to sale, shareholders who are more than 5% of the share capital cannot make up more than 40% of total 40% of total employees. So to try and make that a little bit more understandable, if me and Tasha owned a business 50-50 and we were both employees, and then on top of that, we've got 8 other employees in our business, the number of shareholders who are also employees is 2, which is me and Tash, divided by the total number of employees. Well, that's 10 because there's me and Tash and then there's 8 others. That means we'd be at 20%, and that means it'd all be okay. If, however, 3 of those employees were my brothers, then the top number, which is the number of shareholders who are also employees, starts at 2, but then you've got to add in the number of family employees as well that are related to you. So in that example, we'd be at 5 out of 10 and would be at 50%. And so that's a condition which does sort of generally catch people out. What I'd generally say is that if you've got a significant number of family members employed, or if you've got a relatively low number of employees, so something between 10 and 15, you just have to be careful of that because it can catch some people out. There is also a point that the capital gains tax exemption can be sort of clawed back. And basically, that only happens if there's what's called a disqualifying event. And a disqualifying event is the exact opposite to everything that we've put on this slide. So yeah, just to go through it, what are the disqualifying events? So company is no longer a trading company. It stops trading and starts renting out property, let's say, then it wouldn't work. The EOT ceases to meet the all employee benefit requirement. So again, that's when the EOT isn't being run right and bonuses, any sale proceeds in future are being divvied out amongst employees, not in accordance with hours worked, remuneration, or length of service. The EOT ceases to meet the controlling interest requirement. So again, remember that condition is the EOT always needs to own more than 50% of the issued share capital. So sometimes you just need to be careful. If you were issuing some shares to a new employee, let's say, you just need to be careful on who gets diluted, because if the EOT gets diluted and it goes below 51%, it goes below 50%, then that capital gains tax exemption could be clawed back. The limited participation requirement is breached. Again, that's that number to do with your number of employees. So if you suddenly bring all of your family members on as employees, that could cause you some issues. Or the trustees act in a way which infringes the all employee benefit requirement. Again, that's just trustees not acting in accordance with the best interest of the beneficiaries. So this slide here is here to sort of give you an idea of sort of what the structure looks like. So at the bottom middle, you've got the trade co. So that's the existing business. And you have a board of directors which controls the trading company. That's the exact same principle as what happens now. Any trading company will have some directors, and those directors control the day-to-day activities and management of the trading company. The directors don't need to change when you do an EOT. So if you're a director now, you can be a director post-transaction, but the board of directors will continue to control all the day-to-day trading activities of the trading company. The trading company has something that's called the Articles of Association. The Articles of Association are effectively the company's rule book that says what directors sort of can and can't do, what the company can and can't do, and that regulates the trading company. Trading company is owned by the Employee Ownership Trust, or the EOT, which is in the middle. The EOT will have a trust deed, and the deed of trust is effectively there to tell the trustees what they can and can't do. And then on the left-hand side, rather than just having direct trustees associated with the EOT, the sole trustee of the trust is a limited company of which directors are appointed to that, which sounds like we're just adding in another layer of complication, just for complication's sake. But there is a couple of benefits to that. The reason it's structured like that is because one, it's a hell of a lot easier to make people directors of a limited company than it is to make people trustees of a trust. And two, it limits the trustees' liability. So if something went wrong and someone tried to sue the trustees are safeguarded because they've only got limited liability because they're within a limited company.
Couple of questions that we get asked, Connor, are how many trustees do we need to have?
Mm-hmm.
Yeah. Do you want to go into that in a bit more detail?
Yeah, so ordinarily we'd, 90% of our transactions will have I'll have three trustees. So the rules changed in the budget last year, which effectively said that now a majority of the trustees can't be made up of people who sold the shares to the trust. So anyone that sells their shares to an EOT can become a trustee, but there needs to be a sufficient number of other people who aren't sellers that are also trustees. So generally what happens is that we have three trustees. One of them is one of the sellers. The second trustee is generally, to be honest with you, it's someone that generally works in the finance department because they already know the numbers and they already know what's going on. The third trustee, you can bring in another employee or another trusted individual within the business, or you could look at appointing an independent trustee, just to make sure that everything's being done and run right. So you can have more than that, but generally three. How the trust deed is drafted is that generally we get all of our trusts drafted on the basis that in order for the EOT to make a decision on what happens, all of the trustees have got to make the same decision. And the reason for that is to give a little bit of protection to the sellers, in that if the trustees voted to try and remove you as a director of the trading company, for example, you as a trustee could vote no to that. And so you've not got control in terms of everything you say goes, but you've got an element of what's called negative control so that you can block any poor decisions that aren't in the company's best interests. So what we've got for you now is a couple of examples just to show you sort of how an EOT could work. So in this one, we've got ABC Limited valued at £10 million, and it's got surplus cash of 1 million, and that company is owned 50-50 by husband and wife. The shareholders of ABC sell 100% of the company to the EOT for £11 million. What would happen is that obviously on completion, that EOT's got no money. You can't just create a trust with £10 million in it. Otherwise, everybody would be doing it. So what would happen is that surplus cash that's within the business that the business doesn't need, that would be paid to the EOT, which is then paid out to the shareholders on completion. So they've just received £1 million on completion. And then that £10 million would be deferred. Now, as a rule of thumb, if you don't take out any finance and you sold 100%, it'd take you somewhere between 7 and 9 years to get your money out in totality. And so normally when people say, EOTs sound too good to be true, what's the catch? Normally we say, yes, you get your capital gains tax exemption, but it takes you a little bit longer to get your money out. Some people like that, some people don't like that. But, Tasha will go into it a little bit more, but you can go out and raise some finance to accelerate some payment on day one. I would always highly encourage that because whilst ever you've got your money, whilst ever your money's not being paid, you are still connected and at risk with the business. And so, I'd always encourage you to go out and get some finance and take more cash out on day one. On top of the consideration, if the husband and wife continue to work in the business, they'll continue to be paid market rate salaries and pension contributions. So you're not just living off your capital effectively from the sale of the trust, you are getting paid a market rate salary. And importantly, you can also take part in the tax-free bonuses. So up until October last year, you actually had to do that. There is an opt-out of that now for people that we're sellers. There's not a right or wrong answer as to why you do it. I suppose it just comes down to your morals more than anything else. Yeah, you can take part in the tax-free bonuses as well. The other option that we've got is one that we're seeing quite a lot of people interested in at the minute, and people are looking at this as an opportunity to sort of de-risk themselves from the business. So we've got a couple of these on at the moment with probably some guys in their probably early 40s that have got a decent sized business and want to take a big chunk of cash out, but if they take a dividend, they're going to pay a massive amount of income tax. Or if they sell the business, it's going to be too early for them in terms of retirement. You don't have enough money to see them through. So what some people are doing is effectively cashing in some of the chips and selling 51% of the company to the EOT. So in terms of how that would look, working on the exact same example as the previous one, the company's valued at £10 million. We're only selling 51% of it, so we're only selling £5.1 million worth of the value of the trading company, but then we add on 100% of the cash. So you sell 51%, but you actually sell for 6.1 million. That excess cash is paid to the shareholders on completion, and the 5.1 million is deferred over a period of time again. So again, you can go out and raise some finance to sort of speed that up, or you can just pay out a future cash flow within the business. The difference between doing 51% and 49%, obviously, is that you're retaining some shares. And so the husband and wife will get the 6.1 million out tax-free. They'll continue to get market rate salaries and pension contributions. Once their money's paid off, they can continue to take some dividends out of the business. And then hopefully, when the business does sort of kick on, because all the employees and everyone in the business is all incentivized to sort of grow it and generate these profits, so that employees can have more money out of it. Hopefully, as the value of the business increases, you've still got 49% left over. So that 49%, you can have a second bite at the cherry further down the line. That disposal will still be charged to capital gains tax in the normal way, but hopefully the increase in value will probably cover off any tax liability that arises anyway.
Just a quick one on that, Connor. So, a question what we get asked quite a bit is, can you just pick and choose anywhere between sort of 51% and 100%? Is there any? Can you?
Yeah, so you can sell anywhere between that. The only condition is that the EOT needs to acquire more than 50%. So you could sell 50.00001% to an EOT. We have got clients that have done 75%. We've got clients that have done 80%. Again, there's no right or wrong answer. It just comes down to your sort of need, want, and desire for sort of some cash out of the business, and sort of what's going to drive the business sort of commercially, really. So there isn't a right or wrong answer, but you can sell whatever percentage you like. So if we were going to do an EOT for any of our clients, what steps do we take? We first put together a step plan. So we work very closely with lawyers that we use for EOTs that are also EOT specialists. So we put a step plan together that involves, do we need to extract some property beforehand? Is there any debt? Do we need to try and work out, are there any timing differences to do with the cash? So we work quite closely with the lawyers to design the plan from start. We do all the tax structure and advice. So we work with you to try and sort of work out what should be done in what order in order to maximise tax efficiency. We apply to HMRC to get tax clearance that that we're not doing anything dodgy, and that it all qualifies for all the reliefs that we are assuming it will do. We do a lot of post-deal planning. So again, it's on there as well, but mainly that's looking at an inheritance tax position. We'll come on to inheritance tax shortly, but it is something that everyone needs to be sort of having a think about. We'll do the valuation of the group. So again, I'll work quite closely with Tasha. We'll do some sort of benchmarking in terms of, what are other companies in the market sort of looking to sell for, and what can you get out of it. We'll review all of the legal documents from a tax perspective, make sure they're all up to scratch, managing the project all the way through. Provide a due diligence report. So from last October there was a condition that came in place that said the trustees have got to ensure they're not overpaying for the value of the shares. So what we do is that we put a valuation report together, and then we do what we call a red flag style sort of DD report, which basically says, if anyone saw this, would it put you off doing the transaction? And then we send the DD documents and the valuation off to another firm to get the valuation report approved and agreed, so that the trustees have got some comfort. We do the IHT planning again. I'll come on to IHT on the next slide. And then quite uniquely, we do quite a lot with employee communications as well. So for all of our EOTs, probably the week or two before completion, we'll come out and do a presentation to all the staff, so that everyone understands exactly what they're doing, and no one thinks that they've become the MD overnight or anything like that. So yeah, we're more than happy to sort of come out and do that presentation to the staff, make sure everyone understands what's happening, why it's happening, what the benefits to the staff are, and then hopefully everyone will kick on as intended. So I know this was badged as as purely about EOTs. IHT does come into it with EOTs, but this applies more generally as well. Currently, if someone dies and they've got some shares in a trading company, they can qualify for a relief that's called business property relief. And what business property relief says is that if you die while you hold shares in an unquoted trading company, then the value of your shares are effectively not charged to inheritance tax. It's worth noting that inheritance tax is due at 40% as well. So if that relief wasn't there and your company was worth 10 million quid, you'd have a £4 million inheritance tax liability. With BPR, currently, the liability is nothing. From 6th of April next year, that's changing. So I presume people have seen it in the news. We're talking about the farmers. It's exactly the same thing that will be happening to you guys, but it's received nowhere near as much in the press. So business property relief from next April will be capped at £1 million per person. So if you've got a business, if husband and wife have got a business that's worth £10 million, overnight you go from having no inheritance tax liability to a 1.6, £1.8 million inheritance tax liability. So it's really, really key that you consider your inheritance tax position, whether or not you sell your shares in the company. What I would say is that £1 million per person is non-transferable. And that makes quite a big difference, because the majority of people in the UK will have what's called mirror wills. And mirror wills effectively say that on the first death, everything goes to the spouse. On the second death, everything then gets divvied up amongst the kids. What we ought to be thinking about is sort of looking at changing wills so that shares, especially in family businesses, are passed on to kids on first death. Because if you don't use that £1 million allowance, you could lose it. And so rather than getting £2 million between you and your wife, then you only get £1 million. So it's definitely worth looking at. If you've got a relatively valuable, quite a valuable trading business, and you've not, even if you have actually looked at your wills recently, I'd strongly urge you to look at them again. We have got a wills trust and probate team, and so if that's of interest, let us know. We can put you in touch with someone. But it's absolutely crucial for inheritance tax planning. That's looked at. Just in terms of the IHT and sort of what you can do, we work with a firm of financial advisors to do some personal cash flow planning. So we've got some software that effectively assumes that you live right up to the age of 100. And it says, based on your current spending plans and your patterns, and giving kids some money for university and first house deposit and all those big things in life, you're going to have X amount of money left over when you get to age 100, let's say. And that just gives us a little bit more clarity in terms of what can we actually afford to give away without it impacting our quality of life. So that's actually really, really useful for people who aren't sure what to give away and how much, because it can give you some comfort that it's not going to impact on your quality of life. Quickest way to save IHT is to spend your money. Anyone can do 40% of nothing. Just go out, spend it, enjoy it, have some nice holidays. And then you can look at other options if that's not quite a cup of tea, whether it's gifting some shares into a family trust or whether you look at sort of family investment companies. So all of those things are stuff that we'd consider on not just an EOT but any transaction. And so if IHT is something that you've not thought about yet and you want to have a chat, again, just let us know. I'll pass back over to Tash.
Well, thanks, Connor. So I'm just going to pick up a few bits in relation to how we value the business and some commercial points to consider as part of an EOT. So in relation to the valuation, it's there's many ways that a business can be valued, but generally we'll see that it's valued on a multiple of EBITDA. So EBITDA is your earnings before interest, tax, depreciation, and amortization. It's also referred to as operating profit sometimes. So we will also refer to adjusted EBITDA as well when valuing a business. So that's when we look at the EBITDA position within the account and then add back for any one-off expenditure that's been incurred. So that may be that you've made some large pension contributions that wouldn't be deemed to be or wouldn't deem to be continue moving forward, or you've had some one-off property expenditure within the year, and that would be added back to get to an adjusted EBITDA number. We'd then use that and apply a multiple to that adjusted EBITDA. So the multiple can vary dependent on the size of business, the sector that you were in, the market generally. So we see that there are sort of different multiples across different sectors, whether if you're in the tech sector, then the multiples are quite high at the moment. If you have a six-figure EBITDA, that can normally drive the multiple up. We can also look at sort of other deals that have happened and do a bit of market research to get a gauge of what multiple is relevant for the sector that you are in. So you'd get your adjusted EBITDA, let's say that was £1 million, and you times that by a multiple, and let's say in this circumstance it'd be 5. So you'd start with a valuation of 5 million. We then look at any surplus cash within the business. So we do it on a cash-free, debt-free basis with a normalised working capital. And that is just to ensure that there's the right amount of cash that's left in the business to continue from a working capital perspective. So in relation to the valuation, or the net amount, should I say, that the owner managed businesses will receive, because there's no tax that's payable from an EOT perspective, generally there can be a greater return. So we want to maximise the value that shareholders are getting out of the business. So we don't always have to sort of go over and above from a valuation perspective, because if the value was potentially higher and they were paying more tax, then the net impact may be less of what you'd be getting out of the business than going a different way. However, saying that, an EOT for some businesses is not always the right thing. So we do need to consider the market overall and whether an EOT is the right thing for yourselves as a business, and it's the way that you're going to maximise the return. One point to make is there's no other side through an EOT transaction. So you're not going through sort of negotiations as part of the value, but we do need to make sure that the valuation that is applied is realistic so that it's not challenged by HMRC in the future. Also, the higher the value that's applied, the longer it can take for the employees to pay the vendors off, and that can be quite demotivating. So if you've got a management team that are in place and they're trying to drive the business forward, but you've got a huge amount of deferred consideration that's payable to the sellers, that can be quite demotivating for the team that are in place and trying to drive the business forward. And then, just as we've mentioned, we're seeing partial EOTs at the moment, which allows the sellers to de-risk or the business owners to de-risk. So we can sort of take a view of that from a valuation perspective as well. So a couple of commercial points to consider when doing an EOT. So one being how you're going to fund the transaction. So as kind of previously mentioned, you could look at taking debt out on day one to pay for an element of the consideration. That we're going to go into a bit more detail in relation to how it can be funded in the next couple of slides. But that is it. That is a key point of how will it be funded? Is debt going to be taken out, or is it going to be funded through future profitability and cash generated from future profitability? We will prepare a set of forecasts as part of the process. So we'll make sure that the valuation that's been applied and how that's going to be paid over a number of years is realistic and that the business can afford based upon future profitability, and whether we're going to take any debt out. It can all be flowed through to a set of forecasts, and we can make sure that it's realistic from the business moving forward. As Connor mentioned, we do a finance and legal DD report. So that is a really useful exercise just to highlight if there's any key areas that would be sort of raised through a due diligence process that would raise any concerns for a potential buyer if you were going through a third party sale. And it's actually a really useful exercise to do just to identify any key considerations that you should be taking. Bonuses are payable to employees, so it may be that you've never paid any bonuses before, and as part of the forecast we have that conversation as to what that looks like and what that feels like from a bonus perspective and whether the business can afford based upon the current sort of performance. The board of trustees, so as Connor mentioned, the trustees are there in the interest of the employees rather than just for the directors or the shareholders that were there previously. So we need to make sure that the right people are sitting on the board of trustees and they've got the right interest for the employees moving forward. Like you would with any sort of sale or any plan for an exit, making sure the right management team that are in place is key. So that they're going to be in place post the EOT. It may well be that the sellers are going to stick around and they're going to be there to help run the business moving forward, but they are planning from a succession perspective to make sure that you have got that management team moving forward that can help run the business. And that links to the next point to ensure that you've got the sustainability of revenue and profitability moving forward. That the management team are incentivised and are key as part of that process to ensure that your profitability remains there to repay the consideration moving forward. We've referred to whether an EOT is right. So a consideration of that could be the market appetite. It might be that within the market we're seeing that there's a lot of transactions going on within your sector, and the key point for this is, are you maximising your return? So is it right to do an EOT, or should we be considering a third party sale, or should we be considering private equity investments? And that's where our corporate finance team can help support as well at that point. So it's just a key consideration that we should be taking when we're looking at what options are available and what the right exit strategy is. The impact of the balance sheet and credit rating moving forward. So if as part of deferred consideration, you're taking out more than what the business is actually receive or actually making from a profitability perspective, that can have a negative impact to your balance sheet, which can ultimately impact credit rating and can affect some credit terms that you've got with your suppliers. So it is a key point to be considering now when you're thinking about what you're going to be taking out over a number of years and what the profitability is, making sure that you don't put too much strain on the business that can negatively impact it moving forward. A separate set of accounts are required for the trust company, so it is its own legal entity, as Connor mentioned previously. So a separate set of accounts is something, so that's just more from an admin perspective to mention. And then if a partial EOT is done, the shares that are retained, as Connor mentioned, if the business is continuing to grow, you de-risk and you get an element of the proceeds out now. And then as the business grows, you then go again and you get a second bite of the cherry. So it's a useful thing to consider whether you're going to do a partial EOT or 100%. So just in relation to the funding side of things, so how you are actually going to finance the EOT and how the sellers will get the money out moving forward. So there's 3 options to consider here. So we mentioned about raising finance and raising debt to potentially pay the vendors for the sale of the shares. So we could raise debt, or if there was the assets within the business, then we could raise debt on day one and potentially look at repaying the sellers on day one. What we do need to consider here is, though, we don't want to put too much strain on the business, so it's heavily geared and the debt has been put in place to just fully pay the sellers off, and it's putting a strain on the business moving forward, which impacts the management team and future profitability. So ways of raising debt is via asset finance. So you could look at, if you've got assets such as property or plant and machinery within the business, you could raise finance against them that can ultimately pay an element of the consideration off the sellers. We could also look at invoice financing. So if you've not got any debt against your debtor book, then there's ways that you can lend against that to potentially release some cash and pay that off as part of the transaction. There's other sort of cash flow loans that could be looked at and could be considered as part of, once the forecasts are prepared, could the business actually afford to take out any debt and use that debt to repay the sellers. That's one way, just to fully raising debt to pay the sellers off. Another route is via deferred consideration, so not looking to take any debt out at all and just purely deferring that consideration over a number of years and using future profitability and any cash generated from future profitability to pay the sellers off. Or it's a split, so split between debt and deferred. So it may be that you want to take a bit of asset finance out to release some cash to pay day one and then pay the rest over a number of years on a deferred basis. We find that if the sellers are staying around for a couple of years, then they're quite keen to defer an element because they're going to be around, they're still going to have a huge involvement in the business, they're going to be helping drive forward profitability as well, so that keeps them sort of engaged because they're getting the money out as well. Shall we jump to any questions?
Yep.
So let's have a look. So we have a question. Can the EOT involve a current shareholder who currently takes no active part in the day-to-day operations of the business?
So if you're saying, if you've got a shareholder who is a shareholder in a business but not an employee, if they sell to the EOT, can they take part in the capital gains tax exemption? The answer is yes. So the sellers don't need to be employed by the company. The trust just needs to acquire at least a 50% interest. At least more than a 50% interest in the company. It doesn't make a difference whether they also work for the company or not.
Okay. Another one is, how would a partnership or LLP fund an EOT? As generally any money left in the business is retained profit, which already belongs to the owners.
It's a good question. The simple answer is a partnership and LLP can't do an EOT. It's only available to limited companies. So what you could look at doing if you was interested in it is that you could look at incorporating the partnership or the LLP and then look at doing an EOT. You'd have to be careful on the incorporation because there are some rules. So there's a rule for something called incorporation relief. But incorporation relief says that you can't incorporate a partnership mainly to just get a tax benefit, and so an EOT, selling for your business tax free, could be viewed as obtaining a tax benefit. So you could just look at you could just look at incorporating those, but again, you'd have to be careful.
Another question is, could you do a hybrid, so part EOT, MBO, or would it be better to incentivise senior management with share options?
That's a really, really good question. It is possible to do a part EOT, part MBO. The EOT's obviously got to have the controlling stake. And what we have seen before is, a company that's 60% owned by an EOT and then 40% owned by a management company. It's definitely possible. Whether you do that or whether you go down the EMI route, it'll probably vary depending on the circumstances. To be honest with you, and sort of whether that management team are sort of ready to take over now, or whether you still need to be involved. I think if you're looking at selling to an EOT or MBO hybrid, and then want to leave the business on day one, then an MBO EOT hybrid could be pretty good. If you're going to stay in the business and the management team need a little bit more nurturing and a little bit more guidance, it's going to take you a few years, then the EMI might work better. Because it's not just giving them shares straight away, it's making sure that they earn those shares. So it's certainly possible, and a really good question. But for me, I'd suggest it'd depend on sort of how sort of ready they are to take over the reins.
A good question that we've been asked is, what about existing EMI schemes that are in place?
So if you've got an existing EMI scheme in place, so let's say me and Tash own a company, 50-50, and we've got an employee who's got some share options over 10%. That employee is able to, it depends on what it says in their option agreement, but the employee could exercise their share options and take part in the sale to the EOT. And they'd just be entitled to the money over the same terms as what the vendors are. There are some people that might suggest that for an employee, you'd maybe pay them out a little bit quicker. I'd be hesitant to do that. I'd put them on the same terms as what you've got, because the minute you've still got all your money at risk as well. So any employee that's got an EMI scheme can certainly take part in the sale to the EOT as well, yes.
So another one is, do all shareholders have to sell to the EOT?
No, they don't. So again, the condition is only that the EOT has to acquire at least 50%. So if you've got 5 shareholders, each owning 20%, shareholder 1, 2, and 3 could sell 20% each, and the EOT acquires 60%. Shareholders 4 and 5 don't have to sell anything. So no, you don't have to. You don't have to all sell sort of equally or anything like that. You can sell in different proportions. That's not a problem at all.
So another one is, do you have to decide and stick with the financing option that you choose for the duration, or can you adjust this over time? So you can adjust it over time. In relation to the deferred consideration, you can, there's sort of things that we can put in place so that if the business isn't performing as you'd expected, you can sort of tailor the amount that's payable. But in relation to the financing, if you raise funding, then the business moving forward can, if they get to a better position with cash, they can repay that funding. There's flexibility that we can put in the agreements to sort of put that flexibility in moving forward. I think, Connor, is there anything that you'd add?
No, I think that covers it. Covers it well.
Can interest be charged on the deferred consideration? So yes, we have seen that.
Yeah. So you can charge interest. Got to make sure that it's at no more than market rate. It's worth knowing that the interest element is taxable. You don't get the tax-free exemption on the interest as well, but you can charge interest on the deferred consideration to the EOT, yes.
Could an EOT be used to buy out a couple of the directors or shareholders who are older than the rest of the management team? In
theory, yes, it could do. I think I'd probably sort of question whether the EOT is the right sort of model for doing that, because if the rest of the management team are going to buy those shares and then grow it and then look at doing something themselves in 2 or 3 years, it might be better for those guys to buy the shares initially, grow it for another 2 or 3 years, and then look at doing an EOT or some sort of trade sale themselves. So the answer to the question is yes, you can. But it'd be interesting to know your reason why you'd want to do an EOT for that.
Another one is an EOT a practical solution when none of the shareholders work within the business?
That's a good question. I think the answer's probably yes. And I suppose if the shareholders aren't involved in the business, I suppose it brings that sort of dynamic of all being part of one team and sort of everyone working together, sort of back in the house really, rather than working working your socks off for someone that you've never seen before. So I suppose in theory the answer's yes, but I could also probably be argued the other way. So it could definitely be doable. Again, that's not a problem even if the shareholders aren't employees. Yeah, it's definitely doable.
If the current company ownership is 95% family owned, with one major shareholder having 80%, would an EOT be suitable?
Yeah, certainly. So you certainly could do that. So it does, like I say, it doesn't make a difference who's got what share proportion or how that share dynamic is made up, as long as the EOT is made up of more than 50% of the issued share capital, then it's doable. I suppose the only question I'd have is if it's family owned, is that next level of family coming in? So do you want to actually look at passing shares down a generation to kids and to kids as kids? If you haven't got that next layer of family coming through, then EOT could be an option, certainly.
And then we've got an IHT question. So just having just had our wills rewritten at the end of 2024, I wasn't advised on the IHT change in 2026 and didn't realise this would affect leaving shares to wife and kids. Would you advise having this looked at again?
I'd certainly ask the question of your lawyer, definitely, or your will writer, whoever you used. If you want to give us the facts and send us a copy of your will, we'd be more than happy to have a look over it, sort of free of charge, just have a quick scan over it. But for the amount of tax potentially at stake, depending on if you've got a limited company, how valuable those shares are, certainly I'd be getting another look at it just in case.
Another one is, can you gift the EOT arrangement to the next generation? So if the deferred consideration hasn't fully been repaid, can that be passed on?
Yes, it can. So if you sell to an EOT for £10 million and the EOT owes you £10 million, you can work with a lawyer to effectively gift that debt onto your kids if you wanted to. So it's something that we do quite frequently with regards to the IHT planning that we do alongside it. Yes, you can.
Does the seller take the same risk over not receiving deferred consideration as they would in a normal share sale, such as if the business is not performing and not having to meet the strength to meet the deferred payments when they fall due?
I suppose so, but I suppose the difference is that with a trade sale, if you sold your business to a trade buyer, you'd probably get 50% or 60%, cash on completion, with the rest of it in some sort of shares in the company or some sort of earn-out or deferred consideration. And any earn-out or deferred consideration would normally be satisfied within 3 years. I suppose with an EOT, the thing is that that's going on for a bit longer. So if it is going to take you between 7 and 9 years to get your money out, if something does go wrong with the business, then there's a chance that you don't get that money out. So I suppose you could argue that the risks are slightly higher with an EOT. I suppose the point I'd say to that is that if you're going to keep on working the business and you've had 25 years of the business all being well, if the business keeps on being run and managed as it is being now, then that risk should hopefully be minimal.
Couple more then. So, do the employees taking part have to be UK nationals?
No, it's all employees of that business. So if you've got any employees that are resident over in, let's say the States, they have to be included. The only consideration really is that if they're resident in the US, then they might not have the same tax rules as us, and so their bonus might not be tax free. So they do have to take part, but they may not see all the benefits that the UK guys do.
Great, thanks. And then, are there any minimum or maximum value of sales?
Maximum, no. Minimum, again, sort of not really. I'll probably, if a business is worth less than, probably say £500,000, it's probably not the right time for sale anyway. And but there are some instances where you might still do an EOT in those instances. So I suppose the answer is sort of not really, but obviously the lower you get, the more likely that you're going to have not enough employees to meet the participation requirement. And if you've not got enough value, it means that the business isn't generating as much cash. So how are you going to get your money out? And so once it gets to the real lower end of, if you're saying that business is worth 200 grand or 250, I'd probably say it's not worth doing. If you're getting probably closer to sort of £500,000, it's probably where it starts in general becoming more doable.
And then if the financing of the EOT is deferred, who gets priority? Is it the sellers or the staff, or is that agreed by the board of trustees?
Yeah. So the excess cash always goes to the sellers, because it's drawn up as part of in the legal documents. So the legal documents will say that the sale price is £10 million on a cash-free, debt-free basis. So that £10 million is just the underlying value of the trading business itself, and not it doesn't include any excess cash or excess debt within the business. And so that figure's always added on. So the sellers effectively get the benefit of any excess cash, but they could choose to leave some behind if they wanted to sort of have a stronger working capital position.
Great, thanks, Connor. So there were a couple of other questions around sort of fees and support in relation to the process. So I think it would be really useful if you've got further questions and you want to explore this any further, then as I said, we'll follow up with a diary invite so that you can set up calls directly with Connor or myself and the team, and we can sort of go through the process in a bit more detail. But we hope that you found this session very useful, and we're here if you've got any queries moving forward.
Yeah.
I think just before we go, as I say, we'll follow up with today's slides and the recording of the webinar. There'll be a couple of articles and a case study that we've done with a client, which I think will be useful. And then, yeah, get in touch if there's any further questions. Thank you for all attending.
Thank you, guys.
Thanks, everyone.